So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, Kirk here again from OptionAlpha.com, and welcome back to The Daily Call. Today we are going to answer the question, what do you do when one leg of a bull call spread is assigned? So first of all, let's go over what a bull call spread is. A bull call spread is an option buying strategy where you are buying one call option and then selling one call option at a higher strike price. So let's assume that a stock is trading for $100. You might buy a 105 call option and sell a 106 call option to help cut down the cost of buying that 105 option. So it is a option strategy where you are bullish on the underlying security, you want the underlying security to go higher, and you are a net buyer of options. So you're actually not a net seller. In this case, you're a net buyer. So what happens when one of these legs is assigned? Well, the first thing is that the only leg that would ever be assigned to you, traditionally assigned if you want to use the technical term, is the option contract that you sold. So in our example, if we bought the 105 call option, we would only have the choice as the option buyer to assign or use that option contract as we wish at expiration. That's our choice. That's our right as an option buyer. The 106 call leg that we sold to help finance the purchase of the 105, that is the option contract that as an option seller in this case, as the little option seller in this case of part of the strategy, that we might get assigned to us. So it would only really be assigned to us if the stock was dramatically higher than where the stock is trading or where that strike price is. So if the stock rallied from, say, $100 all the way up to 110, then yes, the 106 option that you sold might be assigned at that point, and you might have to cover those shares. So what do you do in this case? Well, the first thing you can do, there's really two things you can do, I guess. The first thing that you can do if you want is you can exercise your long option contract at 105. Now, this is what people traditionally would do, is they would exercise their contract because that contract is covering and is meant to help protect against that type of scenario happening where one contract gets assigned and the other contract can help cover that assignment. So in the case of this example, if we were assigned stock at 106 and basically short stock at 106, we could then use our long 105 call options. We could exercise those, be long stock at 105. It would cancel out the short stock at 106, and we would be left with the difference as profit in this case. The other thing that you can do, though, and the reason I say that this is probably the better alternative to go, is you can just simply buy back the underlying shares that you're short. So if you get assigned on the 106 call options, just go in the open market and buy back those shares. Yes, you can do that. Yes, the brokers know that you are assigned stock, and so you have to cover that stock. So you can buy back those shares in the open market. And then at the same time you do that, just sell the option contract that you are still long at 105. Just sell back that option contract. This is a difference in how you do it. It's not the same thing. It does accomplish the same mission, but it's different because you don't have to go through the exercise and assignment of the 105 call option. And what that typically means for most brokers is that you have dramatically less commissions the second way of doing it versus the first. So most brokers charge actually pretty much an arm and a leg for you to go through and assign or exercise an option contract. And they charge you a pretty hefty commission to do this. So I'm saying avoid that and just do the pieces individually. And that would probably be, in most brokerage accounts, probably be less costly as far as commission goes to buy back the underlying shares in the open market. That would basically take care of the 106 call option assignment, and then just sell back the option contract that you're long at 105 in the open market, just like we would typically close an option contract position and reverse that very quickly. So you could probably get this all done for like $2 or $3 in commissions, depending on what brokerage you have, versus going through assignment, which might be $15 per option contract that's assigned. So it could be a little bit cheaper alternative if one side is assigned. In either case, though, since you're doing a spread, you should be pretty much risk defined, profit defined here. So you should make or lose about the same amount of money no matter what happens, depending on when you got into it and where the options are relative to the stock, etc. So hopefully this helps out. As always, if you guys have any questions, let me know. And until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.